Amazon stock jumped 15% as investors celebrated AWS earnings and AI payoff. Find out more in today's presentation.
So today we're unpacking Amazon's Q2 2026 earnings report, and man, there is a fascinating paradox hidden right in the middle of it. We're basically looking at the story of a company burning through cash at an absolutely unprecedented rate, yet somehow that aggressive spending spree sparked a massive market rally. It's wild. Let's jump right into the data to figure out exactly why the market reacted this way. To really grasp the scale of this reaction, you just have to look at the stock price. I mean, after initially jumping about 9% in after-hours trading, Amazon shares just kept going. By the end of the trading day following the earnings report, those shares had skyrocketed roughly 15% from their pre-earnings level. Investors were clearly thrilled with what they saw.
But this brings us to a massive contradiction, right? How does a company's trailing free cash flow completely plunge into the negative while they simultaneously commit to a mind-blowing $220 billion in capital expenditures, and yet the stock still shoots up? Normally, Wall Street completely punishes companies for burning through cash like this, so why on earth did they cheer this time?
To solve this little mystery step by step, we're going to look at three things: unpacking the growth engine, the price of AI, and finally, the long-term outlook. Let's start with part one, unpacking the growth engine and validating the hype.
The core thesis of this whole explainer is that this was fundamentally an AI infrastructure quarter that absolutely crushed Wall Street's expectations. If you look at their top-line financials, there's a massive 20% jump in revenue to $206 billion. But look right below that, an even more impressive 43% jump in operating income. When operating income is growing more than twice as fast as revenue, well, that's a textbook indicator of expanding efficiency. They aren't just selling more stuff, they're becoming significantly more profitable while doing it. Now, I do want to throw in a quick caveat here. You might notice their net income actually more than tripled, which sounds incredible. But actually, we should note that this was materially boosted by non-operating gains from Amazon's massive investment in the AI company, Anthropic. So the earnings per share growth slightly overstates things. But make no mistake, even if we completely strip that out, the core operating performance was still exceptionally strong.
But let's be real, the absolute star of the show was AWS, Amazon Web Services. During the call, management highlighted a staggering milestone. AWS just passed $200 billion in trailing 12-month revenue. That's a scale that's hard to even wrap your head around. AWS isn't just an offshoot anymore, it's literally one of the largest enterprise businesses on the planet.
And you have to look at the combination of growth and profitability here. AWS is this massive enterprise, and yet somehow it's still speeding up. Growth accelerated to 37% year over year. That's their fastest in 18 quarters. And while they're growing from that huge base, their operating margins expanded to roughly 39%. It basically proves that AI infrastructure is supporting rather than hurting their bottom line profitability. And the crazy part? It doesn't stop with traditional cloud computing. Amazon is successfully building out these massive AI-related revenue engines. Both their AI services and their custom chip businesses have surpassed $25 billion annual run rates. Oh, and sitting quietly right alongside all this AI hype, their advertising revenue jumped 26%, which provides this super profitable cushion, because of course, Amazon always finds a way to sell ads. Which brings us to part two, the price of AI, or the cost of building the future.
So yes, the growth is incredible, but building the future of AI is absolutely not cheap, and this brings us to the number that initially shocked analysts. Amazon's trailing free cash flow plunged from a positive $18.2 billion last year all the way down to negative $7.6 billion. On the surface, that looks like a massive red flag.
But hold on, there's no reason to panic. That negative cash flow is almost entirely explained by their staggering capital expenditures. Amazon basically went on a $53 billion quarterly spending spree. And what exactly did that buy them? They're acquiring the literal physical building blocks of the AI revolution. AI data centers, advanced networking equipment, custom silicon, GPUs, and just vast amounts of cloud infrastructure. Their core business is still generating tons of cash. They're just consciously choosing to spend it all on infrastructure.
And instead of hitting the brakes to protect their free cash flow, management completely doubled down. They actually raised their expected capital spending for 2026 from $200 billion to an absolute jaw-dropping $220 billion.
So this creates a really stark contrast that investors had to weigh. On one hand, you've got these intense short-term pressures, right? Negative free cash flow, rising capex, and the really high execution risk of deploying all this hardware. But on the other hand, you have massive long-term positives. AWS is accelerating, margins are expanding, and the core economics are improving. It really forces us to ask, is this investment cycle way too risky, or is it just a stroke of genius?
All right, let's get into part 3, the long-term outlook, where we finally solve this mystery.
So why did Wall Street actually reward this unprecedented spending? Well, the crux of the answer lies in this philosophy from CEO Andy Jassy. He explicitly stated that demand remains greater than Amazon's available computing capacity. They aren't just speculating on some future trend, they are desperately trying to build enough capacity for customers who are already banging on their door.
And Wall Street didn't just have to take his word for it. The proof is literally in their AWS backlog. It expanded to an enormous $496 billion. That means much of the cloud capacity they are planning and building for 2027 and 2028 is already reserved and contracted by customers.
So the crucial takeaway here is this. Capacity, not demand, is the limiting factor for Amazon right now. To use an analogy, it's like Amazon is spending billions to build massive new highways for traffic that is already sitting right there at the on-ramp with their wallets open. This backlog ensures that these massive investments are backed by real, tangible customer commitments. And that is exactly why the stock jumped 15%. Investors realized that the negative cash flow wasn't a sign of weakness at all. It was just a symptom of overwhelming demand. In fact, management is so confident that they even suggested AWS could eventually hit $1 trillion in annual revenue. With projections like that, we really have to ask, can Amazon sustain this unprecedented AI growth without stumbling over their own infrastructure, or will this current bottleneck be the ultimate test of their dominance? We are definitely going to have to wait and see how it plays out, but for now, Wall Street is fully bought in.